Next, if we agree that the company should maximize shareholders' wealth, now we need to figure out how to achieve this goal. Shareholders' wealth depends on the magnitude or size of cash flows, of returns which they will get, timing of these cash flows, and associated risk. And in order to maximize their wealth, the company should try to maximize the value of dividends returned to shareholders over time and the capital gains which they will receive when they decide to sell their shares. So the company should focus on increasing the share price and dividends payments. What is also important to understand is that shareholders' wealth maximization can also be achieved through maximization of the company's share price. So the company can try to increase the value of its stock and also market capitalization of the company, because these are alternative objectives or another forms of achieving the same goal for maximization of shareholder wealth. Let's have a look at this graph, this diagram, to illustrate this. So these are all equivalent financial goals for the organization. When we attempt to maximize shareholders' wealth, we can achieve this by increasing the share price. Because when share prices are high, it implies that the value of the holdings by each shareholder are high as well. Their wealth goes up and they feel richer when the value of the assets they have increases. Right? So we can achieve this goal by focusing on the share price of the company. Share price is directly related to the market capitalization of the company. In other words, the value of the company itself, how much the whole company is worth. When we maximize the price of individual share, we will also maximize the combined value of all shares. In other words, the market cap. Market cap is the value of all companies' stocks which the company has issued. When one share is maximized, the market cap will go up as well. What is the market cap? How can we calculate the market capitalization? How can we calculate what is the company worth? It is actually equal to the corporate net present value. And the net present value of any company depends on net present value of cash flows obtained in different time periods. Different cash flows which the company can generate during a certain period of time. Net present value. We will focus on net present values of various cash flows, time value for money, in the next few lectures. In other words, when the company focuses on maximizing the value of cash flows it generates, it will be able to maximize its own market cap, the share price, and therefore shareholders' wealth. In other words, all of these financial goals are in fact equivalent if we look at companies' operations in real life in detail. And in order to achieve these goals, in order to maximize the value of the company, the share price, and shareholders' wealth, we need to ensure that we have the best possible financial management, that we make the best possible investment, financing, and dividend decisions. So what exactly financial management is? Financial management is simply concerned with managing companies' money. Things like acquisitions, financing, management of assets, and so on. Financial managers are people who manage finances of the business and who are responsible for the financial health of the organization. Is a key staff member for any organization, both a business and not-for-profit organization. They develop strategies and plans for the long-term financial goals of their organization. They manage organization's financial portfolio, oversee and monitor its investment, make investment decisions. They produce financial reports. They forecast future cash flow needs. They decide on which terms to get loans if necessary. They provide recommendations on issuing new shares, and so on. Financial manager's role involves making three types of highly interrelated decisions: investment decisions, financing decisions, and dividend decisions. If you study finance in other modules at more advanced levels, you will focus on all of these decisions in significantly more details. And of course, all of these decisions are made with a view of maximizing shareholders' wealth, at least in theory. So what exactly these decisions will involve? Investment decisions will involve or include planning and management of short-term and long-term investments and managing associated risks. They need to decide what is the optimal firm size, what specific assets should be acquired, what assets should be reduced or eliminated, what assets should the company possess, what it should invest in. Second type of decisions, financing decisions, is concerned with how these desirable assets will be financed. So investment decisions will determine where you will invest, while financing decisions will determine how you will fund these purchases, where you will get the money. So how the assets on the left-hand side part of the balance sheet will be financed, so elements of the right-hand side parts of the balance sheet. The thing is, the firm can raise funds from numerous sources, for example, by issuing shares and debentures, or by taking various loans, mortgages, and advances. And financial manager will decide how much should be raised from each source. They need to determine the best source of financing, the best financing mix, a combination of these sources, optimal amount of debt and own capital, and how the funds will be physically acquired. If you want to finance your investments with debt, what specific type of debt, on which terms will you obtain, and so on. And the final type of decisions on dividend policy, how to distribute surplus funds among various parties, for example, debenture holders, shareholders, and so on. The thing is, profit which the company has made can be distributed, returned back to shareholders in the form of dividends, or retained within the company. If it's returned to shareholders, again, it can be returned in different way, because the company can decide to pay dividends monthly or annually, or different amounts of dividends. The company can decide to pay significant dividends this year, but not to pay any dividends for the next 5 years, or the other way around. If you invest in the stock market, you will be very well aware of two types of companies, so-called growth stocks and value stocks. Value companies usually pay quite high dividends to their owners. However, their share prices do not grow that quickly. While growth stocks, growth companies, will frequently demonstrate very quick growth of their stock prices. However, they won't pay any dividends at all. So dividend decisions by financial managers will decide what is the best, most appropriate dividend policy for this particular company at this particular point of time. Dividend payout ratio and so on. What proportion of profit must be returned to shareholders in the form of dividends, etc. So all of these decisions, investment, financing, and dividend decisions, apparently should be made in the best interest of shareholders, in theory. In practice, however, this is not always the case, and this is what we will discuss in the next video lecture.